It's a very good afternoon. Thank you very much for joining us, Thato. So why did the US 8.3% CPI print hit the market so hard, especially given that it was down on July's print of 8.5%?
Good afternoon, Nambu. The 8.3% was obviously slightly higher than consensus expectations of 8.1%. And that's just on a year-on-year basis. On a month-on-month basis, people were expecting somewhat of a reduction, but in fact, inflation did slightly tick up by about 10 basis points month on month. But I suppose the real concern was core inflation, which is of course what the Fed will focus on through its PCE deflator, and that accelerated to 6.3% compared to 5.9% in July. So inflation is actually accelerating on a core basis. And this will clearly be a signal that the Fed will take into consideration in its upcoming rate meetings. And we've seen a repricing of rate expectations for the remainder of the year, whereas 75 basis points was the consensus expectation prior to the inflation print. We are now seeing a probability of 1/3 probability of having a 100 basis points hike in the upcoming September meeting versus a 2/3 probability of a 75 basis point hike. And if you add this to the likelihood of another 75 basis point hike in November and perhaps 25 basis points in the final meeting of the year, we could see the Fed funds rate reaching 4.2% by the end of the year, which is a significant increase. And of course, the market then has to discount those expectations. Hence, we saw the large sell-off of 4% on the S&P yesterday, 5% on the NASDAQ.
So if the US Fed does push interest rates too high and too hard, what sort of impact does that have on emerging markets like South Africa? And it's a bit of a multi-pronged question. And what do you think our Reserve Bank will then do come later on in the month when they make their call on monetary policy?
We did, of course, see a slight sell-off in the rand, which is not unusual. So the rand moved to as high as 17.4, then backtracked by 17.3. Bond yields also sold off slightly, with 10-year going as high as 10.9, whereas began the day around 10.6. And so that obviously has implications as far as future bond issuance for Treasury, as well as potential importing of inflation with a weak currency. And of course, we know that we are dealing with underlying cost push pressures around food and oil as well. So importing at a higher rand does then have implications. So the SARB will obviously take all of that into account. Obviously, the run rate for inflation at the moment of 7.8% is clearly above the long-term target range. And that is, we're likely to see a 75 basis point hike at the next meeting, which would take the prime lending rate to about 9.75. And that in itself has implications for credit extension and so on. So it makes the job more difficult for the SARB, not just the SARB, but other EM central banks as well. We've seen obviously the yen depreciating significantly against the dollar, touching 145. And the Bank of Japan yesterday coming out and saying that they would have a look at the cross rate of the dollar to see if perhaps it is getting a bit too severe given their current easing policy, monetary easing.
So Thato, when we look at the local economy, we know that we're all badly affected by load shedding, but from an investment perspective, in terms of investing in stocks, which sectors or stocks do you see as being losers and winners in this environment of load shedding?
Well, in the short term, it would be the sectors that are heavy energy users. So one would consider mining and manufacturing, for example, who are among the heaviest users of electricity. And they obviously have their production halted when load shedding does occur. At least on the mining side, their output is priced in dollars largely, and the rand has weakened, so that does benefit them, even though commodity prices have slightly pulled back. So perhaps manufacturing would be the biggest loser. They haven't had the benefit of significant price increases, and within manufacturing, certain sectors may not be able to push on inflation towards their end customers. And so you would expect to see not only margin compression on that basis, but also disrupted production, which then impacts their relationships with their end customers. So such sectors obviously have been significantly impacted by load shedding. In the longer term, it could be slightly different, as we expect many large companies to start self-generating.
All right, Thato, we're going to leave it there. Thank you very much for your time and your insights, Thato Mashigo. He's the portfolio manager at Sanlam Private Wealth. We're going